to do, of course, is have a lot of assiduity. I like that word because it means sit down on your ass until you do it.
My friend Jim Glassman quoted me in his op-ed piece in the Wall Street Journal yesterday. It's a quote I don't even remember where I made, but it said, I don't know anybody who has ever been successful in timing the market. I don't even know anybody who knows anybody who has ever been successful in timing the market.
I think if you focus on the controllable inputs to your business instead of the outputs, in the long term, you get better results. So the Benjamin Graham quote here is that in the short term, the stock market is a voting machine. In the long term, it's a weighing machine. And I think people are well advised to build a company that wants to be weighed and not voted upon.
What about all the criticism of derivatives and the impact they have had?
That's a little complicated for me. All I know is, I mean, I don't know about derivatives.
for you?
It's way over my head. I've never bought an option in my life. I never bought. Time's on your side when you own a stock. You know, I don't know about putting 3% down and buying a future and a strap and a straddle. That's way over my head. Can't deal with that.
Is that right?
Let somebody else deal with it. Yeah.
In 1982 or 3, when the long government bond got to 15%, a company that was earning 15% on equity was worth no more than book value under those circumstances, because you could buy a 30-year strip of bonds and guarantee yourself for 15% a year. And a business that earned 12% was a subpar business then. But a business that earns 12% when the government bond is 3% is one hell of a business now, and that's why they sell for very fancy prices. Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock because it goes down?
Selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along next day and says, I'll pay you 15, you don't sell it because the quote's 15. You look at the house or whatever it may be. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business. And the longer you hold stocks, the less risky they become. Whereas the longer the maturity of a bond, the more risky it becomes.
You said you watched Bill Gates on Charlie Rose last week, and I did too. Bill said something that I thought was really interesting. He said, the thing you do obsessively between age 13 and 18, that's the thing you have the most chance of being world class at.
Yeah.
Bill said his one thing was coding. What was your one obsessive thing?
I was pretty interested in investments. No, Bill and I, his father, many years ago, right after we met, had a group of about 20 write down on a sheet of paper one word that they thought accounted for their success. And Bill and I, who may have only met twice, didn't know what the other one was writing down. We both wrote down the same word, which was focus. And he was focused on software, I was focused on investments. And it gave me a big advantage to start very young. There's no question about it.
Finally, as you say, Warren, it's your 88th birthday, which is terrific. Look back on a 38-year-old. Warren Buffett said, an 88-year-old. If you were starting out today, would the principles that got you to where you've gotten still apply? In a world of so much technology, in a world of globalization, a lot of things have changed. Have they changed the fundamentals of investing?
Well, the principles, no, they haven't changed at all. I mean, you try to evaluate where a business is going to be in 5 or 10 or 20 years, and you try to buy it at the right price relative to that valuation, and you leave alone the ones you don't understand, and you do not try to guess the market. It's exactly what Ben Graham wrote in 1949, and no, the principles don't change at all.
So Ben Graham still applies?
Absolutely.
In the securities business, you literally every day have thousands of the major American corporations offered to you at a price that changes daily. And you don't have to make any decisions. You have to make, nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. And if you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike call on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25 and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing.
There's something called the efficient market theory, which says that there's nothing in the data, let's say price data, which will indicate anything about the future, because the price is sort of always right. The price is always right in some sense. But that's just not true. So there are anomalies in the data, even in the price history data. For one thing, commodities especially used to trend, not dramatically trend, but trend. So if you could get the trend right, you'd bet on the trend, and you'd make money more often than you wouldn't, whether it was going down or going up. That was an anomaly in the data, but gradually we found more and more and more and more anomalies. None of them is so overwhelming that you're going to clean up on a particular anomaly, because if they were, other people would have seen them. So they have to be subtle.
What was it about margin of safety? Because in a sense, it's a term that you believe in, and you know, according to what I read, it's a book that's on Warren Buffett's desk, and you both are, you know, great. I don't want to use the word disciples, but you're great followers of the teachings of Ben Graham.
I think it's probably on Warren's bookshelf under a pile of papers. I don't think Warren needs to read it anymore. What
was it, though?
You know, I don't really know. I tried to write it to be accessible to the layperson or the professional entering the field. And so I tried to use layman's language and just make it accessible. It's certainly, the term is borrowed from security analysis, and it's meant to be in some ways an intellectual successor to Intelligent Investor, which was the more accessible of Graham's books. So I think it's just another book in that tradition.
More than that. So when they called on...
Maybe if people can't get something, they want it even more.
Well, there may be a lot to that. I think they call that supply and demand. Suppose you wrote recently the preface to the new edition of Security Analysis. Is that the right time, Securities Analysis? What is it you want to say, and why has it remained, A, your lodestar, and secondly, sort of this remarkable, I mean, as everybody knows, I've probably done more conversation with Warren Buffett than anybody alive, and we talk about it all the time, and how, you know, his own Ben Graham experience and coming to Columbia and what it meant to him. Help me understand why this has been such a profound series of principles that have made you, in investments, who you are today.
First of all, I wish I'd met Ben Graham. I never was fortunate enough to do that. I think Warren captured the idea himself in his 1964 article, The Super Investors of Graham and Doddsville.
Right.
And in it, he talks about value investing's like an inoculation. You either get it right away or you never get it. And I think it's just true. I actually think there's a gene for this stuff, whether it's a value investing gene or contrarian gene.
They make a 1 megabit SRAM, CMOS, bipolar risk, floating point data I/O array processor with an optimizing compiler, a 16 dual port memory, a double diffused metal oxide semiconductor monolithic logic chip with a plasma matrix vacuum fluorescent display. It has a 16-bit dual memory. It has a Unix operating system, 4 Whetstone megaflop polysilicon emitter, a high bandwidth, that's very important, 6 gigahertz, double metallization communication protocol, an asynchronous backward compatibility, peripheral bus architecture, 4-wave interleave memory, a token ring interchange backplane, and it does it in 15 nanoseconds of capability. Now, if you own a piece of crap like that, you will never make money. Never. Somebody will come along with more whetstones or less whetstones or a bigger megaflop or a smaller megaflop. You won't have the foggiest idea what's happened. And people buy this junk all the time. I made money in Dunkin' Donuts. I can understand it. When there was recessions, I didn't have to worry about what was happening. I could go there and people were still there. I didn't have to worry about low-priced Korean imports. I mean, I just didn't have, you know, I can understand it. And you laugh. I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle. And it bothers me that people are very careful with their money. The public, when they buy a refrigerator, they get a Consumer Reports. They buy a microwave oven, they do that. They ask people what's the best kind of radar range or what kind of car to buy. They do research on apartments. When they go on a trip to Wyoming, they get the Mobile Travel Guide, or California. When they go to Europe, they get the Michelin Travel Guide. People will hear a tip on a bus on some stock, and they'll put half their life savings in it before sunset, and they wonder why they lose money in the stock market. And when they lose money, they blame it on the institutions and program trading. That is garbage. They didn't do any research. They bought a piece of junk. They didn't look at the balance sheet, and that's what you get for it. And that's what we were being driven to, and it's self-fulfilling. The public does terrible investing, and they say they don't have a chance. It's because that's the way they're acting. I'm trying to convince people there is a method. There are reasons for stocks that go up. Coca-Cola, this is very magic. It's a very magic number. Easy to remember. Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market.
As a student, I was studying economics, and at the same time, I was reading Karl Popper, the philosopher, and studying basic economics, theory of perfect competition, which originally assumed perfect knowledge. And then I was reading Popper, who made it clear that perfect knowledge is unattainable, that even in science you can't validate theories, you can only falsify them. So the two ideas were directly contradictory, and I sided with Popper. And so also, economics was rather using a lot of math, and I was not very good at math. So I rather questioned the assumptions on which the math was based. And that's how I came to this recognition that economics ignored this fundamental difference between natural phenomena and social phenomena, because in natural phenomena, the imperfect understanding, which is part of human nature, unavoidable, doesn't enter into the sequence of events that you are studying. So you can actually establish universally valid laws which can be used both to predict and to explain. And it's actually a really beautiful construction, natural science. In social phenomena, this doesn't work because imperfect understanding enters into the sequence of events, and it introduces an element of uncertainty that's actually absent in natural phenomena. You also have uncertainty principle in physics, but this human uncertainty principle is an additional source of uncertainty. So when Heisenberg discovered the uncertainty principle, it didn't change the behavior of the quanta that it was referring to. Whereas when you discover a theory about social affairs, it actually can change society. So when, let's say, Karl Marx proposed his theory of history, it actually changed his history.
On that note, then, let me close with 5 simple principles, a few ideas of what you might want to think about, principles of investing that may help you. First, invest you must. The biggest risk is the long-term risk of not putting your money to work at a generous return, not the short-term, but nonetheless real risk of price volatility. Even though stocks seem very high, consider what I said in my book, a little plug there. Never think you know more than the market does. You're apt to be wrong if you do. Second, give yourself all the time you can At the extremes, if you're in the 20s, begin to invest in stocks even if you've only got a little bit. If you're in the 60s, invest more in bonds and less in stocks. But always remember that compound interest is a miracle and time is your friend. Third, have rational expectations about future returns and be mentally prepared for market declines. Always remember, in good times and bad times alike, this too shall pass away. I spend a full page in my book on that sage piece of wisdom. If this too shall indeed pass away, and your emotions can kill you, you should keep them out of your investment program because impulse is your foe. Fourth, rely on simplicity. Simplicity above all. There are too many witch doctors in this business with too many. Basic investing is simple. A sensible asset allocation to stocks, bonds, and reserves, a middle-of-the-road selection of diversified funds, a careful balancing of risks and returns, and lest we forget costs, which can kill long-run returns too. Don't disregard low-cost index funds. That's my only plug. Warren Buffett just happens to agree, buttressed by his support, on the importance of cost and on the value of indexing, a nice third-party endorsement, if you will. And fifth and last, when you've followed all of these 4 rules, as I said, and I've meant 1,000 times, if not 10,000 times, no matter what happens, stay the course. Good luck in investing in these interesting times. Thank you.
What we have found from the very time we started our investment council operation 44 years ago, we published as the motto of our business to buy when others are despondently selling, and to sell when others are avidly buying requires the greatest fortitude and pays the greatest reward. Now, this applies not only to stock market cycles, but it applies to particular industries and types of stocks. Basically, we determine that by finding out what is selling at a depressed price. If a stock is selling for a quarter or a half of what it's worth, then it is a bargain and is, in most cases, unpopular with other investors.
Mainly, you like to buy companies that are out of favor. For example, I noticed that your biggest position is in Royal Dutch, but everybody's expecting oil prices to go down. Doesn't that bother you?
Oh, yes, of course it bothers us, but there's so many other factors. We do own a very large amount. In fact, I think Royal Dutch Petroleum is the largest holding in our mutual funds, because at the present price, it's selling for only 4 times what we think it will earn this year. And we estimate that in the long run, it will earn more. And it's selling for less than half what it could liquidate for, and only about 3 times its present annual cash flow, and pays a good dividend. So for many, many reasons, it looks like the best bargain in the energy industry. It's very widely expected that there will be a decrease in the price of oil, and if the low point for share prices is when the most investors are expecting bad news, not after the bad news comes out. Now, it is possible that it might get lower, but we are long-range investors. Our average holding period is 6 years.
6 years.
So in the long run, it'll be worth much more.
Yeah, to the extent that the method of estimating future cash flow requires projections, I would say that projections, while they're logically required by the circumstances, on average do more harm than good in America. Most of them are put together by people who have an interest in a particular outcome, and the subconscious bias that goes into the process and its apparent precision makes it it's fatuous or dishonorable or foolish or what have you. Mark Twain used to say, a mine is a hole in the ground owned by a liar. And a projection prepared in America by anybody with a commission or an executive trying to justify a particular course of action will frequently be a lie. It's not a deliberate lie in most cases. The man has gotten to believe it himself, and that's the worst kind. So I don't think we should. Projections are to be handled with great care, particularly when somebody has an interest in misleading you.
Charlie and I think it's fair to say we've never looked at a projection in connection with either a security we bought or a business we've bought. We've had them offered to us in great quantities. Now, the fact that we voluntarily turned them away when people tried to thrust them upon us. I mean, the very fact that they are prepared so meticulously by the people who are selling the businesses or by the executives who are presenting to their boards and all of that sort of thing. You know, I mean, either we're wrong or they're wrong. I mean, it's a ritual that managers go through to justify doing what they wanted to do in the first place in about 9 cases out of 10. I have never met an executive who wanted to buy something that said, well, I had to turn it down because the projections didn't work. I mean, it's never happened. And there will always be somebody that will come up with the projections that will satisfy the guy who's signing his paycheck or who will sign the deal that provides the commissions. And they will pass those along to whomever else they need, the bankers or the board, to approve it. And it is total nonsense. I was recently involved in a situation where projections were a part of the presentation, and I asked that the record of the people who made the projections, their past projections, also be presented at the same time. It was a very rude act, and
it was regarded as apostasy.
But believe me, it proved the point. I mean, it was a joke. I mean, so we'll leave it at that.
Well, we think first in terms of business risk. You know, the key to Graham's approach to investing is not thinking of stocks as stocks or part of a stock market. Stocks are part of a business. People in this room own a piece of a business. If the business does well, they're going to do all right as long as they don't pay way too much to join into that business. So we're thinking about business risk. Now, business risk can arise in various ways. It can arise from the capital structure when somebody sticks a ton of debt into some business, and so that if there's a hiccup in the business, that the lenders foreclose. It can come about just by the nature of the business. Certain businesses are just very risky. Back when there were more commercial aircraft manufacturers, Charlie and I would think of making a commercial airplane, a big airliner, sort of as a bet your company risk, because you would shove hundreds and hundreds of millions of dollars out into the pot before you really had customers. And then if you had a problem with the plane, the company could go. There's certain businesses that inherently, because of long lead times, because of heavy capital investment, that basically have a lot of risk. And commodity businesses have risk unless you're the low-cost producer, because the low-cost producer can put you out of business. Our textile business was not the low-cost producer, and we had a fine management, and everybody worked hard. We had cooperative unions, all kinds of things, but we weren't the low-cost producer, so it was a risky business. The guy who could sell it cheaper than we could made it risky for us. So there's a lot of ways businesses can be risky. We tend to go into businesses that inherently are low risk and are capitalized in a way that low risk of the business is transformed into a low risk for the enterprise. The risk beyond that is that even though you identify such businesses, that you pay too much for them. That risk is usually a risk of time rather than loss of principal, unless you get into a really extravagant situation. But then the risk becomes the risk of you yourself. I mean, whether you can retain your belief in the real fundamentals of the business and not get too concerned about the stock market. The stock market is there to serve you and not to instruct you, and that's a key to owning a good business and getting rid of the risk that would otherwise exist in the market. You mentioned volatility. It doesn't make any difference to us whether the volatility of the stock market, is averages 0.5% a day or 0.25% of a day or 5% a day. In fact, we'd make a lot more money if volatility was higher, because it would create more mistakes in the market. So volatility is a huge plus to the real investor. Ben Graham used the example of Mr. Market, which is and we've used it. I've copied it in the report. I copy from all the good writers. And Ben said, just imagine that when you buy a stock that in effect, you've bought into a business where you have this obliging partner who comes around every day and offers you a price at which you'll either buy or sell, and the price is identical. And no one ever gets that in a private business where daily you get a buy-sell offer by a party. But in the stock market, you get it. That's a huge advantage. It's a bigger advantage if this partner of yours is a heavy drinking manic depressive. I mean, the crazier he is, the more money you're going to make. So you should, as an investor, you love volatility. Not if you're on margin, but if you're an investor, you aren't on margin. And if you're an investor, you love the idea of wild swings because it means more things are going to get mispriced. Actually, volatility in recent years has dampened from what it used to be. It looks bigger because people think in terms of Dow points so they see these big numbers about plus 50 or minus 50 or something. But volatility was much higher many years ago than it is now, and you had the amplitude of the swings was really wild, and that gave you more opportunity.
I would say that in 54 years, well, I don't think Berkshire's ever bought a new issue. I mean, the idea of saying the best place in the world I can put my money is something where all the selling incentives are there, commissions are higher, the animal spirits are rising. I mean, that's going to be better than 1,000 other things I can buy where there is no similar selling enthusiasm and the desire to get the deal done and extra commissions. That's the single best thing to buy on a given day. I mean, it's
and I can't think of a time we've ever done it.
Yeah.
Ever bought an IPO?
Yeah, never bought one.
No. How can it be?
They don't even call us.
Yeah, but how can it be the best single thing to use your money for in a given day is something that they got everybody in the world out pushing it. It just doesn't make any sense. I mean, I'm not saying that necessarily what we're buying is going to work out better, but there have to always be better things than one single issue. If you make one decision on investing, if you can't find something among all the choices we see that is better than something that and like I say, the commissions they've come down, I think, now on this, but I mean, the highest commission thing that a stock salesman could sell to securities was the new issue. So you have all this push behind it. We like to buy things where nobody's making a dime selling them to us.
We spent many, many years, and we bought many things. I mean, without meeting managements at all, having any entree to them, the stocks, the $5 billion of stocks that we may have bought in the first quarter, most of those were companies I've never met the management, never talked to them. We read a lot. We read annual reports. We read about competitors. We read about the industries they're in. In terms of sizing up managements, obviously if we're going to buy the whole business, that's a different question. Because we're going to buy it, be in bed with them, they're going to run them, and we care very much about whether they're going to behave in the future as they have in the past once we own the business. And we've had very good luck on that. But in terms of marketable securities, we read the report. Well, the answer is I do believe in dividends in a great many situations, including many of the ones companies in which we own stock. The test about whether to pay dividends is whether you can continue to create more than $1 of value for every dollar you retain. And there are many businesses. Take See's Candy, which we own. See's Candy has paid everything virtually out to us that they've earned because they do not have the ability within See's Candy to use large sums, which they earn, intelligently in their business. So it would be an enormous mistake for See's Candy to retain money. So they distributed Berkshire, and we hope that we move that around in some other area where that dollar becomes worth $1.10 or $1.20 in terms of present value terms. If we do that, the shareholder, whether they're taxable or whether they're not taxable, whether they're a foundation or whether they're living on income even, they are better off
if we retain the money, because if they were going to get $1 in dividends and it became worth $1.10 or $1.20 in market value immediately on a present value basis, they're better off selling a small percentage of their stock and realizing the required amount that way, and they will have more money when they get all through doing that than if we paid it in dividends. But if the time comes, and it will come someday, if the time comes when we don't think we can use the money effectively to create more than $1 of market value per dollar retained, then it should be paid out. And like I say, we do that individually within Berkshire, but because we have this ability to redistribute money in a tax efficient way within the company, we probably had more reason to retain all of our earnings. If See's Candy were a standalone company, we would simply pay out a lot of the earnings, practically all of the earnings and dividends, just like we do now, except it goes to Berkshire. We like the companies in which we have investments to pay to us the money they can't use efficiently in their own business. In some cases, that's 100% of what they earn. In some cases, it's 0% of the earn. We own some stocks that don't pay any dividends. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood, and to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And it's conventional practice, and it may, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own one stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to have proper diversification? It'd be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And the truth is, you don't need it. I mean, if you have a really wonderful business, is very well protected against the vicissitudes of the economy over time and the competition. I mean, we're talking about businesses that are resistant to effective competition, and 3 of those will be better than 100 average businesses, and they'll be safer, incidentally. I mean, there is less risk in owning 3 easy to identify wonderful businesses than there is in owning 50 well-known big businesses.
But there is no distinction in our minds between growth and value. Every business we look at as being a value proposition. The potential for growth and the likelihood of good economics being attached to that growth are part of the equation in evaluation. but they're all value decisions. A company that pays no dividends, growing 100% a year, is losing money now. That's a value decision. You have to decide how much value you're going to get. Actually, it's very simple. The first investment primer, when would you guess it was written? The first investment primer that I know of, and it was pretty good advice, was delivered in about 600 BC by Aesop. And Aesop, you'll remember, said, "A bird in the hand is worth two in the bush." Now, incidentally, Aesop did not know it was 600 BC. He was smart, but he wasn't that smart.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth, and you buy a group of them, you basically don't lose money.
Warren, what do you consider the most important quality for an investment manager?
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd, because this is not a business where you take polls. It's a business where you think. And Ben Graham would say that you're not right or wrong because 1,000 people agree with you. And you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reasoning are right.
That's an interesting question for a generation or more. And I must say, frankly, that our studies indicate that you have your choice between tossing coins and taking the consensus of expert opinion. And the results are just about the same in each case. Your question as to why they are not more dependable is a very good one and an interesting one. And my own explanation for that is this, that everybody in Wall Street is so smart, see, that their brilliance offsets each other. And that whatever they know is already reflected in the level of stock prices pretty much, and consequently what happens in the future represents what they don't know.